Hey everybody, Brian Shannon here from alphatrends.net. Today is Friday, the 2nd of January 2015, and we had our first full day of trading here for the new year. Let's take a look at the numbers. First, I want to point out here that I give it some thought, and I'm never longer going to continue to follow gold. I don't trade gold. I don't like gold. I talk about how I dislike it all the time, and I just don't think that there's anything positive to add there. So instead of following gold, I think that what I wanted to replace it with was the Biotech Index. The Biotech Index, in my mind, is a speculative index of equities and gives us a much better idea where some equity ideas are, and it'll be much more valuable to us. So let's take a look at the numbers. We obviously have a new year, and we started out in the red for the S&P 500. That shouldn't be a surprise, as we are below a declining 5-day moving average. And bonds had a great start to the new year, leading so far up 1.1%. Let's take a look. Well, first of all, let's also look at oil, because oil is continuing its downtrend. Just because the calendar changes, that's all it does. It changes the calendar. It doesn't change the trend. So the S&P 500 obviously still in a massive uptrend from lows 6 years ago. On the daily time frame, we're in pullback mode here. We broke some resistance, and then we have to look at this as the potential of, from the failed breakout there comes a fast move lower. On the 10-minute time frame, we're clearly below a declining 5-day moving average. So as I had mentioned on Wednesday, going into the new year, we are guilty till proven innocent and have a negative bias on the intermediate term. That means it's going to be more difficult to find stock trades on the long side while we're below the declining 5-day moving average. But as soon as this market turns back to where we have it back above a 5-day moving average that's flat to advancing, then the buyers will be back in control. For now, we're going to look at this as just a pullback within a primary uptrend and nothing to be concerned about. But we do get more defensive when we're in pullback mode. The Nasdaq was down 31 pennies today here, and this market had broken some support on Wednesday. That support at about 104.5. I had mentioned over the weekend that, or actually over the holiday, I guess, that until we get back above there, that we are going to look at this market as skeptical on the intermediate term, that is guilty till proven innocent, until it can get back above that prior support level. So for now, we're just in pullback mode for equities. We're right on the 50-day moving average. There's nothing that says it has to hold as support. It is often a level that we do find support at, but it doesn't mean that we're going to get a big bounce from it either. We find support here, but then quickly failed. So it's just a piece of information that we want to keep in mind, and it tells us that we want to look at a shorter term time frame to see if in fact the buyers are regaining control. And right now we can say no, they are not, because we do have that declining 5-day moving average. And in 2015, I've been talking to subscribers about this a little bit. Don't be in such a hurry each morning to begin trading. I mean, especially when we have, like the S&P 500, it gapped up today and ran right into the volume weighted average price from Wednesday, and we continued lower from there. So you have to let the market settle down a little bit and be aware that, a gap up in a market with a declining 5-day moving average will often fail, more likely than not. The Russell 2000 was down 69 cents today, and this market last week broke important support at 120. I keep saying last week, but because we had a day off, but obviously it was Wednesday. We're out guilty till proven innocent here on the intermediate term time frame. We're below a declining 5-day moving average. We're at a prior area where we had seen importance, that is, as far as this band of resistance now tested and holding so far as support, but it can't be trusted until we start to see that 5-day moving average flatten out. It is an important level here, of course, so let's just keep that in mind, that this is where we would like to see the market hold as support. But until we have actual evidence that we have higher highs and higher lows above a flat to rising 5-day moving average, we're going to remain a little bit skeptical of the intermediate term. Semiconductors last week broke down. Again, I keep saying last week when I mean on Wednesday. But we are below a declining 5-day moving average, and we have lower highs and lower lows. So we're not going to expect this market to turn on a dime back higher. Perhaps we continue lower down towards the rising 50-day moving average before it finds support. Financials are trying to hold up above this 20-day moving average here. But on the intermediate term, we also are still below the declining 5-day moving average, and we have this prior little band of support here, basically 24.85 to 24.95. That prior support is where we would expect to find resistance. If it can get back above there and hold above there, then we'll be back into a more positive environment for financial stocks. So let's take a look at the U.S. dollar. It's continuing its massive trend from last year and continues to add to its gains. It's in an uptrend, so it's innocent till proven guilty. As I had mentioned for the bonds, that a lot of people were calling this a double top, and then we saw that we got defensive on bonds as it broke below the 5-day moving average, which was declining. And then as we start to see the pattern of higher highs and higher lows above the rising 5-day moving average, now we can look at this and you could say that this might even be what some people would want to call a cup and handle. Either way, whatever you want to call it is irrelevant. The fact is we are still in a primary uptrend for bonds. We've only closed higher one day in the last 2 years or so, and it's still in a positive environment for interest rates. The Fed, you can argue with the Fed and what bonds are doing all you want, but the obvious thing here is that bonds are in an uptrend, and that's the only thing that matters. People have been fighting this bond market for a year and a half, saying that there's no way that interest rates can go lower when the Fed is getting more dovish. So more hawkish rather. Anyways, let's take a look also at this Biotech Index. Now, the biotechs have been in a massive uptrend as well. They've really been one of the clear leaders. Last year, right around in this area, we saw that Janet Yellen said that the biotechs were overheated. I did a thing on Yahoo Finance saying no, in fact, they aren't, that if they can get back above here, we should resume that uptrend. And we're continuing to move higher. So, Janet Yellen doesn't control biotech stocks. The market controls biotech stocks. She can influence them for a short period of time, but right now they are, I think, just a little bit more neutral. We'll keep an eye on them, but they are in a primary uptrend, just showing some near-term neutrality. Oil continued lower today as well, as we had noted, and last week I was talking about the descending triangle in here, or call it a symmetrical triangle, really more than anything, but it had broken the lower band of that. Now I think there's a lot of people saying that oil can't go down any further. It's down too much. It's oversold and this and that. The market disagrees. You can have. It's going to take more than the death of a 90-year-old king to turn the trend around in oil. And of course that king isn't dead, but people were thinking that it would turn higher because he was in the hospital. Maybe that would change some policies over in Saudi Arabia. But the fact is, it's guilty till proven innocent. And for the near term, 54.5 is going to be the minimum it's going to have to take out in order for this market to bounce a little bit further. So oil is still guilty till proven innocent. Don't listen to people who say it's down too much or whatever, because the market is disagreeing with the people who are saying it's down too much, because it continues lower. Shares of Apple just continued a little bit lower here today, and this stock, of course, found support at the rising 5-day moving average here. Last week in Alpha Trends, we had traded the stock. We got involved in it right around in this area here, and then we got stopped out for a very small loss. And as I had mentioned to subscribers, we're not in Apple to make pennies or dimes or quarters. We're in it for points, and if the points don't come and we can get stopped out with a small loss, we want to get stopped out with a small loss and avoid this bigger pullback. So Apple heading into the new year, regardless of what news is, who's saying what about it, it is in a downtrend. It's guilty till proven innocent on the intermediate term. It's going to need to clear this prior support at 112 for it to become more neutral and to think that it has the ability to continue to rally once again. So for now, I would say just stay away from Apple. We had also been speaking about Alibaba and the fact that it looked like it was ready to come back down and test the volume weighted average price since the IPO once again. That's right down at about $102 a share even. So Alibaba is making lower highs and lower lows below a declining 5-day moving average. There's no point in owning it right now. And that's the same way we're going to continue to approach approach to the market in 2015. That is, with a consistent, disciplined approach, and to look objectively at what the markets are saying rather than listening to the headlines and predictions and all that. We're going to look at price action and make our decisions based on price action. We're going to miss a lot of good trades. We're going to miss a lot of good big losers as well. But the fact is, we're going to catch a lot of good trades, and we're going to do so in a disciplined approach that we can consistently apply based on market structure. If you're interested in a new approach to the market and you haven't taken a subscription to Alpha Trends in the past, I would encourage you to take a look and see if it's something that can benefit you.